Please like, share, and subscribe. Wishing you happiness and good luck every day.
Today, we're going to demystify the world's biggest financial market, Forex. We're going to look at it as a game, complete with rules to learn and players to get to know, all based on the fantastic work of trading expert Mario Singh. So, let's jump right in. Okay, to really get a sense of what we're dealing with, let's start with this number. $4.7 trillion. That's the average amount of money that changes hands in the Forex market every single day. Now, to put that into perspective, that's more than 23 times bigger than all the world's stock markets combined. It's a truly staggering amount of money. And this brings us to a really crucial point from our source author Mario Singh. His argument is simple. Because of its incredible size and influence, Forex affects every single one of us. It doesn't matter if you're a student trying to understand global finance, a business owner dealing with international payments, or just an investor trying to protect your money. It is simply too big to ignore. So, how in the world do you even begin to understand something so massive? Well, Mario Singh suggests we just reframe it. Instead of getting bogged down in some complex financial system, let's think of Forex as the world's biggest game, one that has rules, players, and a way to keep score. So why does this metaphor work so well? Well, first, it has to be fun, or at least engaging enough to hold your interest. Second, you play with the intention to win. And third, and this is the most important one, it has very clear rules. And as we're about to see, if you ignore those rules, they will absolutely break you. All right, every game has its star players, right? In the Forex game, they aren't people, they're currencies. So let's meet the 7 majors. So here they are. The 8 most traded currencies on the planet. You've got the heavy hitters like the US dollar and the euro. The US dollar is involved in pretty much every major transaction, which makes it the most liquid currency out there. And high liquidity just means you can buy and sell massive amounts of it really quickly without totally messing up its price. Now here's a key thing about Forex. You never just trade one currency at a time. They're always traded in pairs. And when these 8 currencies pair up with the US dollar, they form what's known as the 7 major pairs. Get this. These pairs make up over 85% of all daily trading. This is where the main event really happens. This chart just drives that point right home. I mean, just look at the dominance of the euro versus the US dollar. At 28%, it is by far the most traded pair on the planet. And why is that? Well, it's because it represents the 2 largest economic areas in the entire world. The massive amount of trade and investment flowing between the US and Europe makes this the most active playing field in the game. Okay, so we know who the players are, but how do we actually keep score? Let's break down the fundamentals of how to read a Forex quote. Whenever you see a quote like UR/USD, the first currency on the left is called the base currency. And its value is super simple. It's always 1. The quote is just telling you how much of the other currency it takes to buy 1 unit of that base. So the currency on the right, that's the countercurrency. If the quote for Euro/USD is, say, 1.3255, that just means it costs you 1.3255 US dollars to buy 1 single euro. It's the countercurrency that's always fluctuating, telling you the relative value of the base. Now, here's one of those specific little rules of the game you just gotta know. Most currency pairs are quoted to 4 decimal places. But whenever the Japanese yen is the countercurrency, the quote is only given to 2 decimal places. It's a little quirk known as the yen factor that every player needs to be aware of. So how do you measure your wins and losses? In pips. A pip is basically the smallest change in value for a currency pair. For most pairs, that's the 4th decimal place. So a move from 1.3255 to 1.3256 is a 1 pip gain. Now, depending on how much you're trading, that one tiny pip could be worth 10 cents or $10. It is the fundamental unit for scoring this entire game. Now that we know the basic rules, let's look at what happens when you break them. And we're going to dive into a very personal story from the author, Mario Singh, about his very first trade, a really powerful lesson that ended up costing him $3,000. This was literally his mindset going in. He just dropped $3,000 into his first account. He saw the British pound versus the US dollar hit a new high, and he thought, what goes up must come down, right? So, full of confidence, he decided to short the currency, which is just betting that the price is going to fall. But the market didn't listen. The price just kept climbing. So he sold again, doubling down on his bet. And it went up even further. As he tells it, pure panic started to set in. You know that feeling. Everything that could possibly go wrong was going wrong. He was trying to fight the market. And believe me, the market was winning. And here's the result. 6 days. That's all it took to lose every single penny. His broker issued what's called a margin call, which is basically when your losses get so big they automatically close all your positions so you don't go into even more debt. The entire $3,000, just gone. A totally devastating, but as it turns out, incredibly valuable first lesson. So what was the crucial mistake? The rule he broke? It was the most fundamental one there is. Don't fight the trend. The market was clearly showing upward momentum, but he let his own little theory that what goes up must come down override what was actually happening. He was betting against the flow of the entire market, and he definitely paid the price. So after a story like that, you might be wondering, why on earth would anyone want to play this game? But his experience actually led to a pretty profound realization about why understanding this market is so important. This was some advice he got from one of his mentors. After losing all his money, Singh realized he had a choice. He could either blame the market for being unfair, or he could work on himself. He chose to get better, to actually learn the rules, and to try to become one of the very small percentage of traders who consistently succeed. It's not about the game being easy. It's about the player becoming skilled. And this is where it all comes back to you. Why does any of this matter? Well, for some, it could be about creating a second stream of income. For investors, it's about protecting your stocks from currency swings. For business owners, it's about managing your costs. But really, at its core, it's about understanding the huge global forces that shape all of our economies. By the way, all the ideas we've covered in this explainer, the game, the players, the rules, they're all drawn from this book by Mario Singh. It's a really fantastic resource if you want to dive deeper into the strategies for actually playing the game and playing it well. You know, I think this is the perfect quote to start wrapping things up with. It's such powerful advice, and it doesn't just apply to trading, but to pretty much any skill you want to master. The challenge itself doesn't change, you do. If you focus on getting better, on learning, mastery will eventually follow. The Forex market never sleeps. It's a 24-hour game that's happening all around us, all the time, influencing everything. Now that you know the basics, the real question isn't whether you'll be affected by the game. It's whether you'll choose to understand it. Thanks for watching.
Hey, welcome to The Explainer. Today we're going to break down Forex trading. You know, it's the biggest financial market on the planet. And guess what? It's not just for the big Wall Street banks anymore. It's wide open for people just like you and me.
All right, so here's the game plan. We're going to wrap our heads around just how massive this market is. Then we'll meet the main currencies, the big 7. After that, I'll show you how to actually read a trading quote before we get into the really juicy stuff, leverage. It's the most powerful and yet the riskiest tool in any trader's toolbox.
Okay, let's kick things off with the sheer scale of this market. And honestly, calling it big just doesn't do it justice. So, get this. The Bank for International Settlements crunched the numbers, and on an average day, the Forex market trades about $4.7 trillion. Yeah, it's a number that's almost hard to comprehend, but what makes it truly insane is the time frame we're talking about.
And that's the real kicker, isn't it? We're not talking per year or even per month. That's every single day. It's this non-stop global river of money.
So to really put that in perspective, check this out. The daily churn in Forex just completely crushes the global stock markets combined. We're talking more than 23 times bigger. This creates something called high liquidity, which is just a fancy way of saying it's super easy to buy or sell whenever you want. And that's exactly why millions of traders can jump in and out of the market so smoothly.
Okay, so in this giant financial ocean, who are the big fish? I mean, you can technically trade hundreds of different currencies, but really, most of the action, the real drama, happens with just a handful of key pairs.
And here they are, the 7 majors. Now, you'll probably notice one thing right away, right? The US dollar is in every single one of these pairs. That's no accident. It really cements its role as the world's main reserve currency. And because these pairs are so stable and have so much volume, they make up something like 85% of all the trading that happens every day.
But even within that exclusive club, there's a definite pecking order. The euro versus the US dollar, what traders call EUR/USD, is the undisputed king of the hill. It accounts for a whopping 28% of all trading volume all by itself. That makes it, by far, the most watched currency pair in the entire world.
All right, so we've met the players. Now, how do we read the scoreboard? A Forex quote can look a little intimidating at first, just a bunch of numbers. But trust me, it follows a really simple, straightforward logic.
Okay, first things first, the base currency. It's super simple. It's always the currency on the left side of the pair, and it's our starting point. Just think of its value as always being 1.
And right next to it, you've got the countercurrency. That's the one on the right. Its job is just to tell you how much of it you need to buy that one single unit of the base currency.
So, let's put it all together. If you see a quote that says EUR/USD equals 1.3255, what does that mean? It just means that at that precise moment, 1 euro is worth 1.3255 US dollars. That's it. It's just a direct exchange rate.
Okay, so we know these prices are constantly fluctuating, right? But a lot of the time, they're moving by these tiny, tiny fractions of a cent. So how on earth do traders keep score and measure their profits and losses with such small movements?
Well, the answer is something called a pip. A pip is basically the smallest unit of measurement for a currency pair. It's the fundamental building block for figuring out your profit and loss in the Forex world.
It's pretty much always the very last decimal place in a quote. So for most of the big pairs, like the euro/dollar, that's the 4th number after the decimal point. A tiny move from 1.3255 to 1.3256, boom, that's a 1 pip change.
Now, here's the best part. While it's great to understand what a pip is, you do not need to be a math genius to trade. Seriously, every single modern trading platform out there does all the heavy lifting for you. It calculates the value of your pips automatically and shows you your profit or loss in real time right there in your account's currency.
Okay, this leads us to what is maybe the most powerful and, let's be honest, the most misunderstood concept in all of retail Forex trading: leverage.
So, what is it? At its core, leverage is really just a way of doing more with less. It's a tool that lets you control a whole lot of money using just a little bit of your own. It's all about amplifying your trading power.
Let me break down how it works. Imagine you want to control a position worth $100,000. Well, if your broker offers 100-to-1 leverage, they're basically fronting you the capital. You only need to put up 1% of that, or $1,000, as a sort of good faith deposit. And that little deposit, that's called your margin. This is the magic that lets traders with smaller accounts play in the big leagues and control much larger positions in the market. But, and this is a huge but, this power-up comes with a massive warning label attached, because the very same tool that can blow up your gains can do the exact same thing to your losses.
All right, let's paint a picture. Imagine 2 traders, Trader A and Trader B. They both start with the exact same amount, $10,000. The only thing that's different is how much risk they're willing to take. Trader A goes all in, using high leverage, 100-to-1. Trader B, on the other hand, is way more cautious, using just 10-to-1 leverage.
Okay, now watch what happens when the exact same trade moves against them by just 50 pips. Trader A, with that high leverage, is actually controlling a $1 million position. That 50-pip move cost them $5,000. That is half of their entire account, gone on a single trade. Meanwhile, Trader B, who's controlling a much smaller position, only loses $500, which is just 5% of their capital. See that? Same trade, but a wildly different and, for one trader, devastating outcome. And this right here is probably the single most important thing to understand about leverage. It's a neutral amplifier. It has no feelings. It doesn't care if you're winning or losing. It just takes the outcome and makes it bigger, for better or for worse.
So this really leaves us with one final and absolutely crucial question. Leverage can take a tiny ripple in the market and turn it into a tidal wave in your account. The real skill isn't just learning how to use this powerful tool. It's having the wisdom to decide how much risk is right for you.
All right, today we are jumping headfirst into the wild, high-stakes world of Forex trading. We're talking about the massive global market where, believe it or not, trillions of dollars change hands every single day. Fortunes are won and lost literally trading money itself. So how does this game actually work? You know, from the outside it can look super complex, but really at its heart, it's a game of speculation with some pretty clear rules. So the big question is, how do traders actually make money in this giant global arena? Well, let's break it all down.
Okay, first up, the billion-dollar bet, understanding the basic moves. To get this, we've got to start with the most fundamental action a trader can take. And you know what? It all boils down to just one simple decision. Which way do you think a currency's value is about to go? When it comes right down to it, you've really only got two moves. If you think a currency is about to get stronger, you go long, you buy it. And if you think it's going to get weaker, you go short, you sell it. That's it. It really is that simple. You're either betting it's going up or you're betting it's going down.
Okay, let's make this concrete. Say you've got a hunch that the Australian dollar is about to rise against the US dollar. So step 1, you buy 100,000 Australian dollars. Now, let's say a little while later the rate moves just a tiny bit in your favor. You sell it all back. And boom, just like that, you've pocketed a $500 profit from a pretty small change in price.
Now, hold on. You're probably thinking, wait a minute, $500 profit on a $100,000 position? That's a ton of capital for a pretty small return. And you would be absolutely right. But traders have a secret weapon, a tool that completely changes the game, and that tool is called leverage.
So if you had to put up all that cash yourself, the full $100,000+, your return on that trade would have been, well, less than 0.5%. Yeah, not exactly going to make you rich, is it?
But check this out. With 100-to-1 leverage, your broker lets you control that exact same huge position with just a tiny deposit, maybe $1,000 or so. And suddenly, that $500 profit becomes a jaw-dropping 48.4% return on your money. Now, before you get too excited, here's the huge critical catch. Leverage is a double-edged sword. It's a psychological trap, right? It makes you feel way richer than you are, because while it blows up your gains, it will magnify your losses just as fast and just as brutally. So with that kind of power at your fingertips, you just can't trade on a whim. The stakes are way too high. You absolutely need a clear, disciplined plan. And that brings us to our next section, your 3 critical decisions. These are things you have to decide before you even think about clicking buy or sell.
So for every single trade, you have to define these 3 key points. First, your entry price. That's simply where you get in. Second, your profit target. That's your goal, your exit plan for when you're winning. And third, and this is the most important one, your stop loss. This is your safety net. It's the price where you automatically bail on the trade to cut your losses if things start going south.
So here's how it looks when everything goes right. The dream scenario. You buy, the price starts to climb, and then, ping, it hits that profit target you set earlier. The system automatically closes your trade and your gains are locked in. Beautiful. Mission accomplished. But what if you're wrong? It happens. The price starts to fall. Now, instead of just sitting there, panicking, watching your money disappear, the price hits your stop loss. The trade is closed. You take a small, acceptable loss. And listen, this is not failure. This is smart, disciplined risk management. This is the move that keeps you in the game to trade another day. And I really want to drive this point home. The source material is crystal clear on this. The single most important lesson is to always use a stop loss. So many traders blow up their entire accounts because they just sit there hoping a losing trade will magically turn around. A stop loss isn't just some optional tool. It's your financial life jacket. It's pure self-defense. All right, moving on to the hidden cost of trading, understanding the spread. So you know how to get in and out of a trade now, but there's this little hidden cost, a fee that's built into every single transaction you make. You've got to know about it.
And that cost is called the bid/ask spread. The easiest way to think about it is like a tiny cover charge you pay to get into the club being the market. See, there's always a slightly different price for buying a currency compared to selling it. And that tiny little gap between the two, that's the broker's fee. It's how they make their money.
So here's what that means in practice. The market has to move a little bit more in your favor than you think. In Forex, we measure the tiniest price movements in what are called pips. So look at this. If your goal is to make a 30-pip profit, but the spread, the broker's fee, is 2 pips, the price doesn't just need to move 30 pips. It needs to move 32 pips for you to hit your target. It basically means you start every single trade just a tiny bit behind.
Okay, we've got the mechanics of a trade down. But what's causing all this chaos in the first place? What are the giant forces that make these currencies bounce around all day? Why do prices actually move? That brings us to what moves the market.
At the end of the day, it's all about supply and demand, and that supply and demand is driven by 4 major forces. You can think of these as the giant engines of the Forex market. You've got economic factors, political factors, natural disasters, and of course, pure speculation.
First, economic factors. This is all about one thing: growth. When a country's economy is doing well, like in this headline, where strong consumer spending was reported, investors see that country's currency as a good bet. They want to buy it, and all that buying pushes the price up. Simple as that.
And political factors work pretty much the same way, but in reverse. Stability is good for a currency. Instability is terrible. So when a country has a political crisis, like the protests in Egypt mentioned here, investors get scared. They pull their money out, traders dump the currency, and its value just tanks. Uncertainty is basically kryptonite for a currency.
And then there's the raw power of speculation. The most legendary example of this has to be the story of Black Wednesday. Back in 1992, the famous speculator George Soros decided the British pound was way overvalued. So he and his funds started selling it, billions of pounds. The British government fought back, burning through 27 billion pounds of its own money, trying to prop the currency up. But they couldn't hold back the flood. On September 16th, they finally gave in. The pound collapsed, and Soros, he walked away with over $1 billion in profit. It's just an incredible display of how powerful a big speculative bet can be.
Okay, so you've got all these massive forces pushing and pulling prices in every direction. How on earth does a trader make sense of all that noise? Well, they look at the charts. The charts are basically the visual language of the market. Which brings us to our final section, decoding the market's language.
The most common way to look at prices is with a candlestick chart. And each one of these little candles you see tells a whole story about the price in a certain period of time. The fat part, the body, tells you where the price opened and where it closed. And those little thin lines sticking out, the wicks, show you the absolute highest and lowest prices it hit during that time.
Now, when you put a bunch of these candlesticks together, you start to see patterns. The most basic one is a trend. An uptrend is just a series of higher peaks and higher valleys. A downtrend is the exact opposite, a staircase of lower peaks and lower valleys. Just being able to spot these simple structures is the first step for a trader to get a feel for which way the market is heading. And all this brings us to one last really important question. If for every single trade there's a buyer and a seller, why do prices move at all? It seems like it should be balanced. Well, the answer isn't just about numbers in economics. It's about the raw intensity of human emotion. It's about which side is more desperate, the overwhelming greed of buyers shoving the price higher, or the gripping fear of sellers forcing it down. That constant battle between greed and fear, that is the real engine of the market. You know, every single day, something like $6 trillion changes hands in a market that literally never sleeps. It's the foreign exchange market, or Forex, and it is by far the biggest financial playground on the entire planet. So who's really moving all that money?
Well, in this explainer, we're going to pull back the curtain and meet the real power players.
See, the first thing you get is that the Forex market isn't some building on Wall Street. It's a huge, decentralized global network. You've got millions of participants, everyone from giant banks to individuals, all buying and selling currencies at the same time. And all that activity creates this incredible liquidity, which basically just means you can always find someone to trade with, instantly.
Okay, so in this massive financial ocean, who are the big fish? Who's making the waves? Well, it really boils down to 6 main groups. The easiest way to think about it is like a pyramid of influence. Right at the very top, you have the architects of the whole system, the central banks. Just below them, you've got the titans, the big commercial banks, the giant multinational corporations, and large institutional funds. And then, at the base of the pyramid, you've got the facilitators and this rapidly growing crowd. Retail brokers and individual traders, maybe just like you.
So, let's start at the absolute peak of that pyramid, the central banks. Now, what's fascinating about them is they aren't in this game to make a profit. Their mission is much, much bigger. They're trying to manage entire national economies.
You see, institutions like the US Federal Reserve or the European Central Bank have one primary job: keep their country's economies stable and healthy. And their number one enemy? Inflation. That's when prices creep up and the money in your pocket just doesn't buy as much as it used to. If inflation gets out of hand, it can be absolutely devastating for a country.
So, how do they fight it? Well, they have a toolkit with 3 main tools. First, they can change interest rates, which makes borrowing money cheaper or more expensive. Second, they can literally jump into the market and buy or sell huge amounts of their own currency to influence its price. And third, they can tell banks how much cash they need to keep on hand. Every single one of these actions sends massive ripples through the entire Forex market.
All right, moving down a level, we get to the titans of trade. We're talking about the huge commercial banks, the multinational corporations, and the big institutional funds. These are the players who are moving staggering amounts of cash every single day. So, take a huge company like Apple or Nissan. They're doing business all over the world, which means they're dealing with a ton of different currencies. They use the Forex market for something called hedging. Really, it's just a fancy word for financial insurance, a way to protect themselves from the risk that currency values will suddenly shift and wipe out their profits.
And this shows you the two sides of that risk perfectly. Let's say you're a German car company selling cars in America. Your biggest fear is that the euro gets stronger. Why? Because all those dollars you earn from sales will suddenly be worth fewer euros when you bring the money back home. On the flip side, if you're an American company that imports parts from Germany, your nightmare is a weaker dollar, because it makes those German parts way more expensive to buy. Hedging is how they sleep at night.
Now, besides helping clients, banks have another game they play. They trade with their own money. It's called proprietary trading, or prop trading for short. This is where they're not helping a client, they're speculating, making big bets on the market to try and turn a profit for the bank itself.
And as you can probably guess, this is an incredibly high-risk, high-reward game. When you're betting with billions of the bag's dollars, a single bad trade can go catastrophically, epically wrong.
And these three guys, wow, they are the poster children for just how wrong it can go. Through a series of unauthorized, high-risk bets, just these three traders managed to lose a combined total of over $10 billion for their banks. I mean, the numbers are just staggering.
The case of Bruno Ixel, who got nicknamed the London Whale, was so huge that it shook the entire financial world. In fact, even the CEO of JP Morgan Chase, one of the biggest banks on earth, initially dismissed the warnings about these trades. His later admission that he was, quote, dead wrong, just goes to show you how quickly these massive bets can spiral completely out of control.
Okay, so for a long time, the Forex market was pretty much a closed club for these big players. But, as with everything else, technology has completely changed the game. It's led to what people are calling the retail revolution, where regular, individual traders are now a real force to be reckoned with.
And how did this happen? Well, it's thanks to retail Forex brokers. They're the ones who built the online platforms and the trading tools that basically open the doors to the global currency market for pretty much anyone with an internet connection.
And the growth has been nothing short of explosive. In fact, individual traders, we call them retail traders, are now the single fastest growing segment of the entire Forex market. It's a fundamental shift in who's participating. And to put their new power into perspective, just look at this number. While it's still just a slice of the multi-trillion-dollar pie, the daily trading volume from retail traders alone is estimated to be over $200 billion. The crowd isn't just watching from the sidelines anymore, they are in the game.
So, what does this all mean for the future? We've seen the pyramid, right? You've got the central banks at the top, setting the economic weather. You've got the titans, banks, and corporations moving massive ships through those waters. But now, at the base, you have this new, powerful force, millions of individual traders. And it brings up a really fascinating question. As all these small traders join the giants, is the world's biggest market actually becoming more stable? Or is it becoming a whole lot more unpredictable? Only time is going to tell, but one thing is for sure, the game has definitely changed.
You know, more and more everyday people are getting into this incredible game, and it's not what you think. It's called Forex, the foreign exchange market. Today, we're going to break down exactly why you might just want to get in on the action.
First things first, let's talk about the sheer scale of this thing. $4 trillion. I mean, just let that number sink in for a second. That's how much money moves through the Forex market every single day. And that data is from 2010. To put that into perspective, it's way more than a dozen times bigger than all the world's stock markets combined. This isn't just a big playing field. It's the biggest financial arena on the entire planet. No question.
Okay, so that brings up the big question, right? If this market is so gigantic, the place where all the huge banks and mega hedge funds play, why on earth are regular people like you and me, suddenly flooding into it? What's the secret? Well, that's exactly what we're here to unpack.
All right, here's how we're going to tackle this. We'll start with the hook, just how mind-bogglingly big this game is. Then we'll dive into 3 core pillars. Its ultimate accessibility, the unique edge that traders get, and how it's basically the key to understanding all of global finance. And that'll all lead us to the final takeaway on why you really ought to consider playing. Let's do it.
So our first pillar is what I call ultimate accessibility. And this is all about how Forex just smashes through those old school walls that used to keep most of us out of the world of high finance. This is a market that's really built for the way we live today.
The first key to all this access is that the market literally never sleeps. It's not like a stock exchange that rings a bell to open and close. No, the trading day just flows seamlessly from one major financial hub to the next. As Asia is winding down, Europe's just waking up and getting its coffee. And as Europe closes up shop, New York is in full swing. It's this constant overlap that creates a non-stop 24-hour trading day, 5 days a week.
And man, does that make a difference. Think about it. The stock market, it's open for what? Maybe 8 hours a day? If you've got a regular 9-to-5 job, that's a huge problem. But with Forex, you can trade whenever it fits your life. Early morning, late at night, on your lunch break, it doesn't matter. Somewhere in the world, the market is wide open and ready for business. And you're probably thinking, yeah, but I need a ton of money to get started, right? Wrong. That's another wall that has completely crumbled. I mean, not that long ago, you might have needed tens, maybe even hundreds of thousands of dollars. But today, because of the intense competition between brokers, you can open a real, live trading account with as little as $100. $100.
And here's maybe the best part, especially if you're just starting out. You don't even have to risk that $100 right away. Almost every single broker out there offers free practice accounts. They usually call them demo accounts. You get to play with virtual money, but here's the kicker. You're trading on the real, live market prices. It's the perfect sandbox to build your confidence and test your strategies before you ever put a single penny of real cash on the line.
All right, on to our second pillar, the trader's edge. This is where it gets really good. This isn't just about being able to get in the door. It's about the unique structural advantages that are baked right into the Forex market itself.
The first edge is a huge concept called leverage. Put simply, it's the ability to use a small amount of your own money to control a much larger position in the market. It's the tool that lets traders capitalize on currency moves that are often incredibly small, sometimes less than 1% a day. But, and this is really important, it is a double-edged sword. Just as it can amplify your gains, it can absolutely amplify your losses too. And the leverage you can get in Forex is just wild. Some brokers offer up to 500 to 1. So what does that actually mean? It means with just $200 of your own capital, you could be controlling a $100,000 currency position. That kind of financial firepower is something you simply will not find in the stock market. Another huge edge is the cost. When you trade stocks, you usually pay a commission, right? Plus something called the spread. Well, in Forex, you can pretty much forget about commissions. Your only real transaction cost is the spread, that teeny tiny difference between the buying and selling price. And all that competition between brokers has driven these spreads down to just a few pips, which are just fractions of a cent.
And finally, there's total freedom. In the stock market, there are often all these rules that restrict you from shorting, which is just betting that a stock's price will go down. Those restrictions, they don't exist in Forex. Because you're always just trading one currency against another, if you think the US dollar is going to weaken, you can sell it. Instantly. Anytime. No special rules, no hoops to jump through.
And now for our third and final pillar, and this one might just be the most powerful of all, the global financial key. This is all about how learning to trade currencies gives you an incredible lens, a secret decoder ring to view and understand every other market on Earth.
You know, the Forex market can be incredibly transparent. Central banks don't usually try to surprise traders. In fact, they often do the exact opposite. Take this classic example from 2011. For weeks before Japan's central bank intervened to weaken its currency, officials were basically telegraphing their moves, dropping strong hints and preparing the market. They want traders to be on their side. And this is what happened next. The very moment the Bank of Japan acted on those signals, the US dollar-Japanese yen pair shot up 300 pips in a single day. The market was listening, and traders who understood the language of Forex were ready for it.
And this gets to the very core of this idea. A country's currency is the foundation of its entire economy. So when you learn to analyze the US dollar, you're not just trading Forex, you're gaining this deep insight into the health of the whole US economy. This gives you a massive advantage in predicting moves in US stocks, bonds, and commodities, because they are all priced in, you guessed it, US dollars.
So, let's bring it all together. Why should you even consider playing this game? It all comes down to those three powerful pillars we've just explored.
First, there's ultimate accessibility. It's a 24-hour market you can get into with very little money. Second, you get a powerful trader's edge, high leverage, incredibly low costs, and the freedom to trade in any direction you want. And third, it's the key to global finance. When you understand currencies, you gain an unparalleled advantage in seeing how capital is flowing through all other markets.
The Forex market is essentially the pulse of the global economy. It's a continuous, 24-hour conversation about value, risk, and opportunity that's happening all over the world right now. The market never, ever sleeps. So the only question is, are you ready to learn its language?
All right, let's talk about the holy grail of trading, the perfect strategy. What if I told you the answer has nothing to do with some secret market formula? It's actually a lot closer to home. It's about finding the formula that fits you. So let's dive in. Okay, so check this out. It's a classic trading puzzle. You've got two traders looking at the exact same chart at the exact same time. Trader A decides to go long. They buy in. Meanwhile, Trader B does the complete opposite. They go short. They sell. Now, here's the crazy part. Trader A gets out a little later for a nice profit. But then, Trader B also exits their trade, and they also walk away with a profit. So wait a minute. How is that even possible? How can two completely opposite moves both be winners? Well, it proves that the secret isn't just when you get in. It's something else entirely. And you know, this whole thing leads to one of the biggest questions in all of trading. We all know there are winning strategies out there, right? People have proven systems that make money. So why is it that so many traders, even when they get their hands on one of these proven plans, still end up losing? Well, to get to the bottom of this, a trading coach decided to run a really interesting experiment. He wanted to figure out what the real key to success was. You know, was it all about the strategy, or was it something about the person doing the trading? So, here's what he did. He found two traders, let's call them Mike and Amanda. He gave them the exact same starting capital, they had to take the same number of trades, and most importantly, they had to follow the exact same strategy with crystal clear rules. At the end of the month, though, the results were, well, they were wildly different. Mike was up a solid 10%. Amanda? Only 2%. What on earth happened? And when he dug into the data, the answer was right there. It turns out both of them were perfect at getting into the trades. The problem was getting out. Amanda, well, she was a bit impatient. She kept meddling, jumping out of good trades way too early, which just slashed her potential profits. Mike, on the other hand, just trusted the system. He let it do its thing. So you see, same strategy, totally different personalities, and that led to completely different results. And this is the big revelation, the aha moment. See, having a good strategy, that's just the price of admission. The real secret sauce, the thing that leads to long-term success, is finding a strategy that actually fits your personality. There is no one-size-fits-all perfect strategy. The only thing that exists is the perfect strategy for you. You know, to make this idea really stick, let's think about it in a totally different way. Let's use an analogy from the world of sports. Because honestly, finding your trading style is almost exactly like an athlete figuring out which sport they were born to play. Yeah, think about it for a second. Every single trader, including you, is basically an athlete competing in this huge financial arena. And just like an athlete, you've got your own set of natural talents and weaknesses, right? Things like how much risk you can handle, how patient you are, or how you deal with pressure. So if you're an athlete, the big question is, what's your sport? What are you naturally built for? It's about figuring out your unique strengths and then finding the game where those strengths give you an unfair advantage. And that's exactly what we need to do in the market. I mean, it just makes sense, right? A good coach would never look at a super agile soccer player and say, hey, you should be a boxer. No way. They'd look at their skills, whether it's incredible nerve for motor racing or that raw speed for a sprinter, and they'd match the person to the sport. And that is exactly what we have to do for ourselves as traders. Okay, so if we're all athletes, what are the actual sports we can play in trading? Well, it breaks down into 5 main styles. Let's walk through each one, and as we do, I want you to think about which one sounds like it might be a good fit for you. First up, the scalper. If trading were the Olympics, this would be the 100-meter dash. It's all about speed, high intensity, split-second decisions, and thriving under pressure. Blink, and you might miss it. So scalpers are jumping in and out of trades super fast. We're talking minutes, sometimes even just seconds. The goal is to grab a bunch of small, quick wins that add up over the day. Now, this style is perfect for you if you're someone who can stay laser-focused for short periods and you actually like that adrenaline rush. A big plus here is that because you're in and out so fast, your risk on any one trade is really, really small. All right, next we have the day trader. And for them, there's one golden rule that they live and die by. You never hold a position overnight. Simple as that. Everything is opened and closed all within a single trading day. So their time frame is a little longer than a scalper's, maybe a few minutes to a few hours. They're usually playing off the day's big news stories or riding short-term momentum. And the huge advantage here? You get to sleep like a baby every night because you know you have absolutely zero exposure to any crazy stuff that might happen in the markets overnight. Okay, moving on to the swing trader. Now, this style can be a total game changer, especially for those of you with a 9-to-5 job or who just can't be chained to a screen all day. The whole idea here is to catch those bigger swings in the market that happen over a few days. Swing traders will hold a position for a couple of days, maybe up to a week. This means you don't have to watch every little tick of the chart. It's a much more relaxed pace. You avoid all that chaotic noise of the daily market ups and downs, and it can often lead to some really fantastic risk-to-reward setups. All right, now let's talk about the position trader. These are the marathon runners of the trading world. We're not talking days or weeks here. We're talking about holding trades for weeks, months, sometimes even years. They're playing the long game, betting on the big fundamental trends. To be a position trader, you need some serious patience. You have to be okay with watching the market go up and down and just hold on, trusting your long-term analysis. The payoff for that conviction can be pretty sweet, though. You'll have way lower trading costs, and you might even earn interest, known as swap, on your positions. But yeah, this style definitely requires you to do your homework on the big picture fundamentals. And last but not least, we have the mechanical trader. Now, this one is a little different. It's not really about the time frame. It's all about the system. A mechanical trader lives and dies by a specific, pre-written set of rules, and they follow them with absolute robotic discipline. And the benefit here is, well, it's huge. This approach is designed to completely remove emotion from the equation. No fear, no greed, just following the rules. So if you're just starting out and need some structure, or if you're someone who really struggles with the psychological side of trading, this kind of system can be an absolute lifesaver. So there you have it, the 5 big trading styles. You've got the scalper, the sprinter, the day trader, the daily tactician, the swing trader, the patient opportunist, the position trader, the marathoner, and the mechanical trader, the system builder. Now that you've seen the options, the really important part begins, figuring out where you fit in. So seriously, take a second. Think about who you are. What's your day-to-day life like? How much patience do you really have? Are you someone who gets a buzz from fast-paced action, or do you prefer to sit back, analyze, and play the long game? As I was going through those descriptions, did one of them just jump out at you? Did you think, hey, that sounds like me? Because at the end of the day, it really does all boil down to this one simple idea. How you trade is a reflection of who you are. And if you try to force it, if you're a natural sprinter trying to run a marathon, you're just setting yourself up for a world of pain and frustration. It's just not going to work. So here's the bottom line. Stop looking for the perfect strategy. It's a myth. It doesn't exist. The real quest is to find the perfect strategy for you. And that journey doesn't start by looking at a chart. It starts by looking in the mirror and figuring out who you are. So the only question is, are you ready to find it? Hey there, and welcome. Today, we're going to gear you up with 2 really powerful, high-speed strategies, both built for the fast-paced world of currency scalping. You know, some trades can last for days, even weeks. But today, we're diving into the trenches. We're talking about scalping, a world where trades are over in the blink of an eye, and the action, well, it pretty much never stops. So here's our game plan. First, we'll get our heads around what scalping really is. Then, we'll break down our 2 distinct strategies, the rapid fire for when the market's really on the move, and the piranha for when it's kind of quiet. And finally, we'll cover the most important part, how to know which tool to use and when. So, what is this art we call scalping? Well,
It's not about hitting home runs. It's about getting on base again and again and again. It really takes a specific mindset. You got to be precise, disciplined, and ready to act in a split second.
This right here, this is the life of a scalper. You're making a ton of trades, constantly jumping into the market to snatch small, consistent profits. And you're doing it all on these super short time frames, like 1-minute or 5-minute charts. Now, the catch? It demands your full attention. It can get exhausting if you're not careful. And that brings us to the golden rule. The source material really hammers this point home. Discipline is everything. It's so easy to get caught up in the heat of the moment, but you have to set personal rules. Maybe you decide to take a break every hour, or you just stop for the day once you hit a certain target. This quote is a great reminder that trading more doesn't always mean making more. All right, let's grab the first tool from our kit, the Rapid Fire Trend Strategy. And just like the name says, this is your go-to weapon when the market has a clear direction and is really starting to pick up some steam. Okay, let's check out the vitals for the strategy. We're focusing on the Euro-USD pair, mainly because it's the most liquid on the planet. For a scalper, that means tighter spreads and being able to get in and out of trades instantly. And we're working on the 1-minute chart. Yeah, where each candle is just 60 seconds of action. This can spit out 30 to 40 potential trades a day. It's a ton of action, but man, you've got to stay focused. So, how do we spot our entries? Our first indicator is the parabolic SAR. Just think of these little dots as your guide. When they're below the price, that's a sign of bullish momentum. When they're above, it's bearish. When those dots flip from one side to the other, bam, that's our primary signal. But we never trade on the SAR alone. We need a filter to confirm the bigger trend, and that's where the 60-period simple moving average comes in. The rule is super simple. If the price is above this line, we're only looking for buy trades. If it's below, we're only looking to sell. It's our way of making sure we're swimming with the current, not against it. Okay, so let's walk through the playbook for a buy trade, step by step. First, you confirm the price is above our trend filter, the SMA 60. Then, we just wait for a little pullback where the SAR dots pop up above the price for a moment. Our signal to jump in is the exact moment the price moves back up and those SAR dots flip underneath it. Once you're in, you immediately set your stop loss 15 pips below and your profit target 10 pips above. Everything is planned out. No guesswork. Okay, check this out. This is that exact moment we're talking about. The price is clearly trading above that solid SMA 60 line, which confirms our bullish bias. Then, right there in that highlighted box, you see the price bar close above the SAR, and poof, the dots flip below. That is our precise signal to enter the trade. And here's the full trade, all mapped out. We've got our entry price, the EP, marked right at the signal. Below that is our stop loss, the SL, which is our safety net. And above is our take profit, the TP, our 10-pip target. And the key thing here, all of this, your entry, your exit for a loss, your exit for a win, it's all decided before you even click the button. That removes the emotion, and that is the secret to disciplined scalping. Now let's switch gears and grab our second tool. This one is called the Piranha range strategy. And honestly, if the rapid fire strategy is for a fast-moving river, the Piranha is for the calm, still waters, when the market is just drifting sideways. I just love this metaphor from the source material because it perfectly captures what this strategy is all about. You're not trying to land a whale here. You're just taking these small, quick 5-pip bites out of the market over and over again. And it's the frequency of those little wins that makes this whole thing so effective. All right, the vitals for the Piranha are a little different. Here, we're watching the GBP/USD, which a lot of traders call the cable. And we've also slowed it down just a tiny bit, moving to the 5-minute chart. Don't worry, this still gives us plenty of action with about 15 to 20 potential trades a day. Now, the beauty of this strategy is just how simple it is. It really just relies on one indicator, Bollinger Bands. Basically, when the market is calm and ranging, the price tends to bounce between these outer bands. So we start to think of the upper band as being overbought or expensive, and the lower band as oversold or cheap. So setting up a buy trade here is incredibly simple. It's just 2 steps. First, you make sure the market looks calm and is moving sideways. Second, you enter a long trade the second the price touches that lower Bollinger Band. From there, your risk management is super tight. A 10-pip stop loss and a tiny 5-pip profit target. It's all about getting that quick bite and getting out. Okay, let's see this on a chart. You can see the market is just kind of drifting sideways, staying inside the bands. Then, right there in the box, a candlestick dips down and clearly touches that lower band. That's our signal right there. The market is likely oversold, so we're expecting a little bounce back toward the middle. And here's the full plan laid out. The entry price is right where that candle touched the band. Our stop loss is tucked just a few pips below it, giving us a tight cushion. And our take profit is set for just a quick 5-pip gain. The whole idea is to grab a fast, high-probability win. In and out, that's the Piranha philosophy. Okay, now this is a really cool tip from the source material. What happens when a Piranha trade goes wrong and hits its stop loss? Well, that's not just a loss. It's information. It's the market literally telling you, hey, the calm sideways stuff is over. A trend might be starting. A really savvy trader could then use that signal to start looking for a trade in the direction of that breakout.
All right, this brings us to what might be the most important part of this whole thing. Look, having these two strategies is great, but the real skill, the real art, is knowing which one to pull out of the toolkit at just the right time.
This chart lays it all out, nice and simple. Is the market trending? You grab the rapid-fire strategy. Is it just moving sideways? You unleash the Piranha. They've got different time frames, different pairs, and different indicators, and each one is perfectly designed for a specific market environment.
Look, if you remember only one thing from today, let it be this. Your job is not to force a strategy onto the market. Your job is to read the market first, figure out if it's trending or ranging, and only then do you select the right tool for the job. Analysis first, action second.
So, as you can see, the strategies themselves, they're actually pretty simple. The rules are clear, but executing them with total discipline day after day in the heat of the moment, that's the real challenge. So I'll leave you with this question. Now that you have the tools, are you ready to build the discipline?
Ever wonder how Forex day traders really make their moves in a market that literally never sleeps? Well, today we're cracking open their playbook. We're going to demystify 4 key strategies and turn some pretty complex tactics into a simple, actionable guide you can actually understand. You know, this quote gets right to the heart of the day trader's mindset. This isn't about long-term investing. It's about sharp, decisive action. You get in, you get out, and you finish every single day with a completely clean slate. That means 0 overnight risks and no tossing and turning worrying about what the market's doing while you're trying to sleep.
And that's the million-dollar question, isn't it? If your job is to close out all your positions before the day is done, you can't just be guessing. You need a crystal-clear strategy to slice through all that daily market noise and make moves that count. You need a plan.
So here's our roadmap. First, we'll talk about the day trader's game in general. Then, we'll break down 2 huge technical strategies, fading false breakouts and trading true breakouts. After that, we're going to dive into the news trading playbook, and then we'll wrap it all up with the 1 key takeaway you need to remember. Okay, let's kick things off with the most fundamental rule of day trading. Look, it's not about having a crystal ball. The best day traders don't even try to predict the future. They just become absolute masters of reacting to very specific market signals, right in the moment they happen.
So a day trader's battlefield really has 2 main arenas. On one side, you've got technical analysis. That's all about reacting to what the price charts are telling you. Things like patterns and those big battles at support and resistance levels. On the other side, you have fundamental analysis, which is all about reacting to major news events and the crazy volatility they can cause. Don't worry, we've got strategies for both.
All right, let's get into our first technical strategy. This one's called fading false breakouts, and it's all about learning how to spot a very common trap that gets set in the market. It's how you learn to follow the smart money instead of getting crushed by it. Okay, take a look at this. You see how the price just dips right below that support line? To a lot of retail traders, that's a giant flashing sign that says, sell. But so often, it's a trap set by the big institutional players to trick people into selling right before the price reverses and rockets upward. And this is the whole idea behind fading the break. You're literally betting against what looks like a breakout. So what's the secret signal? The candle's shadow, that little wick, might poke through a support or resistance line, but the body of the candle fails to close past it. That failure, that's your trigger. So how do you actually do it? Well, first, you find a key support level. Second, you spot a candle's shadow dipping below it. Third, and listen up, because this is the most important part, you wait for that candle to actually close above the support line. Once you see that false break, that's when you enter a long trade, betting the price will go up. And of course, you set your safety nets.
a stop loss to protect your downside, and profit targets to lock in those gains.
And here's the payoff. On the left, you see the trap being set. On the right, you see the beautiful result of fading that break. The price reversed just like the strategy said it would, hitting both profit targets. You literally turned their trap into your opportunity.
But what if the breakout is for real? Well, that brings us right to our next strategy, trading true breakouts. This is the complete flip side of the coin. It's not about dodging a trap, it's about jumping on a powerful wave of real market momentum.
So, what's the one thing that separates a false alarm from the real deal? It all comes down to where that candle closes. If the body of the candle closes firmly past that support or resistance line, that's not a trick. That's a powerful signal that the momentum is real and it's got legs.
The playbook here is just as clear. First, you identify a trading range that has obvious support and resistance. Then, you wait and watch for that one breakout candle that closes above resistance. That's your cue. You enter your long trade, you set a smart stop loss back inside the old range just in case, and then you set your profit targets to ride that wave of momentum.
And here we see it playing out perfectly. On the left, that breakout candle closes way above the resistance line. That's your confirmation. Then on the right, you see the follow-through. The price just keeps pushing higher in the direction of the breakout, no reversal, no trap, just pure raw momentum.
So let's put these two strategies right next to each other, because it all boils down to one trigger. If the candle fails to close beyond that key level, you fade the break and bet on a reversal. But if that candle closes beyond the level, you trade the break and bet on momentum. Two totally opposite actions decided by one very clear signal.
All right, we've covered the charts. Now let's pivot from the technicals to the wild world of news trading. When a big economic announcement hits, the market can go absolutely haywire. But believe it or not, there's a simple rule that can help you cut right through that chaos.
It's called the rule of 20, and it's a beautifully simple numbers-based rule. All you do is look at the economic forecast. Then you look at the actual number when it comes out. If reality is more than 20% different from what was expected, that's your signal to trade in the direction of that surprise. Simple as that.
Now, when a news report is released, you're going to see three numbers: previous, forecast, and actual. As a news trader, you can basically just ignore the previous number. It's old news. The real fight, the one that actually moves the market, is between the forecast, what everyone expected to happen, and the actual, what really happened.
Let's make this super concrete with an example. Let's say analysts forecast the U.S. jobs report is going to show 300,000 new jobs. Okay, using our rule of 20, the deviation we're looking for is 60,000 jobs. So our trigger to trade is if the actual number comes in above 360K or below 240K. Any result inside that range, it's just noise. We ignore it.
And this brings us to our two news-based strategies, which have some pretty memorable names, actually. You gawk the talk when the news is a positive surprise, and you balk the talk when it's a negative one.
Here's how they work side by side. You gawk the talk when the actual number comes in more than 20% better than the forecast. You're capitalizing on that big positive surprise. And you balk the talk when the actual number is more than 20% worse than the forecast, capitalizing on the market's fear and disappointment. They're just two sides of the same coin, both driven by that same rule of 20.
So let's bring it all together. What we've really done here is build a complete reactive toolkit. You have 4 distinct strategies, 2 for chart patterns and 2 for news releases, and each one is designed for a very specific market condition.
And this brings us right back full circle to the core idea of this whole explainer. Your job as a trader isn't to be a fortune teller. It's to have a clear, disciplined plan for reacting to whatever the market throws at you, moment by moment.
So now you have the playbook. You've got the rules for fading false breaks, trading true ones, and for cutting through the chaos of the news. But knowing the plays isn't the whole game. The real question this leaves us with is, do you have the discipline to actually follow the rules when the pressure is on?
Got a full-time job, but you're still trying to trade the markets? Yeah, it's a classic dilemma, right? Well, today, we are diving deep into a playbook that's built just for you. We're going to break down 3 super systematic swing trading strategies straight from our source material. And these are designed specifically for traders who, can't be glued to their screens all day long. All right, let's get right into it.
Okay, so here's our game plan for today. First, we'll tackle the biggest challenge for swing traders. Then, we're going to walk through 3 different strategies, one by one. Ride the trend, bounce the trend, and confirm the trend.
And finally, we'll wrap it all up by helping you figure out which of these playbooks might be the best fit for you.
So let's talk about the Swing Traders Challenge. How to overcome the biggest hurdle in trading. Now, you might be thinking the biggest hurdle is finding a good trade, but it's not. The real challenge is what happens after you're in a trade, especially a winning one. It's a total psychological battle, and I'm pretty sure every trader listening knows exactly what I'm talking about.
This old saying, the trend is your friend until it bends. We've all heard it a million times, right? But here's the painful truth our source material points out. Most of us treat the trend less like a friend and more like, I don't know, a casual acquaintance we're scared to hang out with for too long. We get into a great trade, snatch a tiny profit, and then just watch in agony as the price keeps running and running without us. So the real challenge? It's simply letting your profits run.
Which brings us to our first strategy, ride the trend. This one is all about letting your profits run. It is designed from the ground up to tackle that exact problem we just talked about. The whole point is to keep you in a winning trade and stop you from bailing out way too early. So let's break down how it works.
Okay, so the engine behind this strategy has two key parts. On the left, we've got exponential moving averages, or EMAs. Think of these as your compass. When a fast one crosses a slow one, it points you in the direction the trend is going. Then, on the right, we've got the ADX. Now, if the EMA is your compass, the ADX is your speedometer. It couldn't care less about direction, north, south, whatever. It only tells you one thing: how strong is this trend? How much gas is left in the tank?
And here are the rules. It's a simple 4-step process. Rule number 1, you wait for the fast 12 EMA to cross above the slower 36 EMA. That's your signal. Rule 2, and this is important, you don't chase. You patiently wait for the price to pull back and just touch that 12 EMA. That's your entry. Rule 3, your stop loss goes right at the 36 EMA. And now for the most important part, Rule 4. Listen to this. There's no profit target. You only get out when that ADX, our speedometer, drops back below 40. That's it.
Okay, let's see what this looks like on an actual chart. So right here, you can see the EMA cross happened, which tells us, hey, we're in a new uptrend. But look, we don't just jump in. This is where the discipline comes in. You have to wait for the price to pull back and just kiss that 12 EMA line. That little touch right there, that's your precise entry point.
And now for the payoff. The magic of this strategy really is the exit. Take a look at the ADX indicator down at the bottom. See how it shot up way past 40? That's screaming strong trend. So what do? Nothing. You just hold on. The exit signal only comes way over here on the right when the ADX finally dips back below 40. That's the sign that the trend is running out of gas. And by waiting for that, you capture the vast majority of the move.
So, what was the result of all that patience? Well, the risk-to-reward ratio on this one example trade from the source material was 1 to 5.4. Let me say that again, 1 to 5.4. That means for every single dollar you risked on the trade, the return was more than $5. I mean, come on, just one trade like that can completely change your month or even your quarter. All right, on to strategy number 2, bounce the trend. This one is for entering on the pullback. Now, if the first strategy was all about riding the entire wave from start to finish, this one is a bit different. It's about letting the wave go out a bit, the ebb, and then catching it on its way back in, the flow. It's a completely different philosophy.
So what tool do we use for this? Bollinger Bands. What these do is create this awesome dynamic channel around the price. You can think of the outer bands as showing you when the price is getting a little stretched, a little too far from home. And that middle line, that's home base. It's the average. It gives us a really clear, objective picture of that ebb and flow we were talking about.
And just like the first strategy, the rules here are totally mechanical. For a long trade, first, you need to see the price touch the upper band. That shows you there's strength. But then you wait. You wait for it to pull back to that middle line, our home base. That's your entry. Your stop loss, that goes at the outer bottom band. Now, here's the big difference from the last strategy. The exit isn't dynamic. Instead, you set 3 distinct profit targets right from the start.
And here's the setup in action on the chart. See this? The price hit the upper band, confirming that upward momentum is there. But again, it's a waiting game. You just sit on your hands until the price comes all the way back to that center line. The second it touches, boom, that's your trigger to go long because you're expecting the price to bounce right off that home base.
So what's the payoff look like?
Well, here you go. You can see the entry, the stop loss is placed safely down at the lower band, and then he just watches the trend continues and hits profit target 1, then target 2, and finally target 3. This approach is absolutely perfect for anyone who likes to systematically bank their profits as the trade moves in their favor. It just feels good to lock in those gains.
And if you manage to hit all 3 of those targets, the total potential risk-to-reward for this play is a very, very solid 1 to 3. It's just a super structured way to aim for a fantastic return while taking money off the table at different points.
Okay, time for our third and final strategy. This one is called Confirm the Trend, or the fifth element. And this playbook is really for the more conservative trader out there. It's all about one word: confirmation. You're not trying to be a hero and catch the exact bottom. Nope. You're waiting for the market to prove to you that the momentum has really shifted before you risk a single penny. And the main tool for this job is the MACD histogram. The best way to think about this is like it's a visual story of momentum. When you see bars below that zero line, the sellers are in charge. When the bars cross above it, the buyers are stepping in. But, and this is key, we're not just looking for one tiny bar to pop over the line. We need to see a real, sustained shift in control. This brings us to the core rule of the fifth element strategy. Here's how it works. First, you watch the histogram flip from negative to positive. Okay, simple enough. But then, and this is the whole point, you wait. You wait for 5 consecutive positive bars to print. You enter on the opening of that 5th candle. Your stop loss goes right under the last swing low, and you set 2 preset profit targets.
Let's look at the setup. Down at the bottom, you can see the MACD histogram flips from red to green, from negative to positive. Now the countdown begins. We see bar 1, bar 2, 3, 4, and on the opening of that 5th consecutive green bar, that is your entry signal. What this does is it filters out so many of those fakeouts where momentum looks like it's shifting, but then just fizzles out.
And here's how the whole trade plays out. You've got your confirmed entry, your stop loss is tucked away logically right at the most recent low before the momentum shift, and from there the trade moves up and hits both of the preset profit targets. It's just a really clean, logical, confirmation first kind of system.
Now the total potential risk to reward here, if you hit both targets, is a solid 1 to 2. Now you might be thinking, hey, that's lower than the trend rider strategy. And you're right, it is. But that's the trade-off. You're sacrificing a bit of that huge upside for a much higher degree of confirmation before you ever put your capital on the line.
All right, so let's zoom out and build your strategy by comparing these 3 playbooks side by side. We've just covered 3 really powerful systematic approaches, right? We had one for trying to maximize those huge winning trades, one for buying the dips on a pullback, and a third for waiting for absolute proof of a trend change. So now, let's put them on the board together and see how they really compare.
This table just lays it all out perfectly. You've got the trend rider, which uses EMAs and the ADX to go for those massive home run trades. Then you have the trend bouncer, which is all about Bollinger Bands and a very structured 3-target exit strategy. And finally, the fifth element, which relies on the MACD histogram for that 5-bar confirmation before aiming for 2 simple profit targets. You can see they each have a totally different personality, a different philosophy about how to approach the market. So you have the strategies, but the real question is, do you have the discipline to execute them? Look, at the end of the day, our source material gives us the playbook. It gives us the mechanical black and white rules. But having the playbook and actually executing the plays under pressure, well, they're 2 completely different things. So the final question isn't do these strategies work, it's do you have the discipline to follow the rules, trade after trade, without exception. That's the real challenge.
You know, when you think of a trader, you probably picture someone glued to 6 screens, right? Just frantically buying and selling every single second. But what if there's a different way to play the game? A much calmer, more strategic approach that's all about the long game. Well, today we're diving deep into the world of position trading. This is the patient trader's game.
Okay, so here's the game plan. First, we're going to define what a position trader actually is. Then, we'll break down 3 really cool long-term strategies: swap and fly, market correlations, and one I call Siamese twins. And to wrap it all up, we'll help you figure out which of these trading personas might just be the perfect fit for you. All right, let's get right into it. What does it even mean to be a position trader? You've got it right there on the screen. This is a marathon, definitely not a sprint.
So is all trading just this frantic race? The short answer, no way. Position trading completely flips that whole high-stress stereotype on its head. It's all about letting time work for you, not against you.
So here's the official definition, but let me break it down. A position trader is someone who's looking at the big picture. They spot a major trend, they get into a position, and then they wait. They have the patience to hold that trade for weeks, months, sometimes even years, just letting that broad market move do its thing. Now, what does it take to be this kind of trader? Well, it really boils down to 3 key things. First, you gotta have a really solid grasp of the fundamentals. You know, the big economic forces that are actually driving the market. Second, you have to get good at ignoring the day-to-day noise, all the hype you see in the news. And third, and this is important, you need an account that's big enough to handle the market's swings without getting knocked out of your position. Okay, and this is where it gets really interesting. This patient style comes with 2 huge built-in advantages that we're about to dig into. You can literally get paid just to wait, and you can use these hidden connections between different markets to find some really unique opportunities. So let's jump right into our first strategy. This is how you can actually earn money just for holding a position open. And honestly, it's one of the coolest perks of being a position trader. What on earth is a Forex swap? It's simple. Think of it like this. It's like earning interest in a high-yield savings account, but for your trades. See, every Forex trade involves borrowing one currency to buy another. And if the currency you're buying has a higher interest rate than the one you're borrowing, boom, you pocket the difference every single day. So the method itself is actually pretty straightforward. First, you find a currency pair that pays you to hold it. Then, you wait for a really strong signal on a long-term chart. You get in, you set your stop loss, that's your automatic safety net, and then, and this is the magic part, once the trade is in profit, you move that safety net up to your entry price. At that point, it becomes what we call a risk-free trade on your capital. And here's a perfect example. We're looking at a daily chart of the Australian dollar versus the Japanese yen. You see that strong upward pattern? It's called the 3 white soldiers. And for us, that's a huge signal that a major uptrend might be kicking off. This is exactly the kind of clear, long-term sign we're looking for. And right here, this is the key moment. The price has moved in our favor. So what do? We slide our stop loss right up to our entry point. From this moment on, the absolute worst-case scenario is that we break even on the price. But all the while, we just keep collecting that daily interest. Now, check this out. Fast forward 36 weeks. Yeah, 36 weeks, and the price eventually wanders all the way back to where we started. Now, in a normal trade, this would be a total wash. No profit, no loss, just a lot of wasted time. But because of our strategy, this is not a loss. And there it is, our profit. Over 300 pips. That profit was earned purely from those daily interest payments we collected over 252 days. This just proves the power of the strategy. You can literally make money on a trade that ultimately goes nowhere. You got paid to wait. All right, let's move on to strategy number 2. This one is all about seeing the invisible threads that connect seemingly unrelated markets. And if you can learn to read these ripple effects, you've got a massive edge. So there are 2 powerful types of relationships we can use. First, you've got positive correlation, where 2 things move together, like oil prices and the Canadian dollar. Then you've got negative correlation, where they move in opposite directions, like the US dollar and gold. So how do you actually trade this? Well, here's the playbook. You're not even trading oil directly. Instead, you watch the oil chart. When you see a decisive breakout, you use that as your trigger to go long, to bet on the price going up, on a Canadian dollar pair. Then you just set your safety net, your stop loss, based on the market's normal daily movement. And this slide just lays it out perfectly. It's cause and effect. On the left, you see the price of oil smashing through a major ceiling. That's our signal. The very next day, on the right, we pull the trigger on our currency trade. The action in the oil market is basically our green light to act in the Forex market. And now for our final strategy. This one shows how economic news from one country can be a direct trading signal for a completely different country's currency. This is a really powerful, fundamental approach. The concept here is so simple, but it is so effective. China is Australia's biggest customer, right? So their economies are joined at the hip. They're like Siamese twins. When China's economy does well, the Australian dollar tends to do well. It's that direct. So this is a clear event-driven strategy. You're basically turning economic headlines into trading opportunities. You watch for those big data releases from China. If the news is better than everyone expected, you buy the Aussie dollar. If the news is worse, you sell it. It's a fantastic way to trade the ripple effects of the global economy. So we've just walked through 3 really different ways to approach patient, long-term trading. And the thing is, each one really suits a slightly different personality. And that's the key takeaway here. These aren't just abstract strategies. They're more like mindsets. Are you the methodical interest earner who loves collecting that steady yield? Are you the correlation reader, the big picture thinker, connecting the dots between markets? Or are you the news trader, ready to act the moment a big headline drops? So I'll leave you with this one question. What's your trading persona? Really thinking about which of these styles resonates with you is the very first step to developing your own patient strategic approach. It's not about being that frantic trader glued to the screen. It's about finding the style that fits who you are and lets the market start working for you.
Let's talk about one of the biggest hurdles in trading, our own emotions. Today, we're going to explore a method that lets you swap out fear and greed for a clear, simple set of rules. It's called mechanical trading, and we're about to break down 3 simple strategies you can use.
You know, if you've ever placed a trade, you know that feeling, right? That pit in your stomach, the excitement of a win, the frustration of a loss, fear, greed, hope, they can all mess with your judgment. So the big question is, what if you could just turn all that off? What if you could trade with the cool, calculated logic of a machine?
Well, you can. The answer is mechanical trading. It's an approach where every single decision, your entry, your exit, everything, is based on a fixed set of rules you define beforehand. So instead of reacting to some crazy news headline or just a gut feeling, your one and only job is to execute your plan. That's it. This discipline is what it's all about.
Now, this rule-based style is a game changer, especially for new traders, because it completely removes the guesswork. You're not sitting there agonizing over whether to click buy or sell. You just follow a checklist. It turns trading from this super stressful, emotional roller coaster into a manageable process. So let's dive into 3 very different strategies that show how this works in the real world.
First up is the Guppy Burst. And yeah, the name is a little funny, but this is a really clever technique. It's designed to take advantage of a very specific, quiet time in the market to catch a potential breakout when things start to pick up again.
So here's the spec sheet. We're looking at the GBP/JPY pair, traders call it the Guppy, on a tight 5-minute chart. The whole idea is to trade a breakout from the range that forms in the 3 hours right after the US market closes. That's a super quiet, low liquidity period. And here's the best part. No indicators. This is pure price action. We're making decisions based only on what the price itself is doing.
So how do we set up a long or a buy trade? It's incredibly simple, just 2 steps. First, during that quiet 3-hour window, you find the highest high and the lowest low. That's your range. Second, you place a pending buy order right at that highest high, which is acting as a ceiling or resistance.
And this chart shows it perfectly. See where the US market closes? That shaded box after it is our 3-hour window. Look how the price just bounces between a clear top and a clear bottom. It's this predictable little box that we're going to trade from. Okay, once your entry is set, your exits are just as mechanical. Your stop loss, that goes at the very bottom of the range, at the lowest low. Then, for your profit target, you just measure the distance in pips from your entry to your stop loss, and you double it. This gives you a fantastic 1-to-2 risk-to-reward ratio, meaning you're always aiming to make twice what you're risking.
And here's the payoff. The price punches through the top of our range, our buy order gets triggered, and it keeps on climbing until, bam, it hits our profit target. A perfect, clean, rule-based trade with 0 emotion involved.
And what if you want to bet on the price going down? Easy. You just flip the whole thing upside down. You put your sell order at the bottom of the range and your stop loss at the top. It's perfectly symmetrical, which is one of the beautiful things about mechanical systems. All right, let's see how this idea of using time-based rules plays out in our next strategy.
Our second strategy has another fun name, English breakfast tea. This one is built around a really interesting little quirk, a pattern that tends to happen with a specific currency pair at a very precise time of day, right as the London market is opening.
For this one, we're watching the GBP/USD pair on a 15-minute chart. Now, the core idea here is really fascinating. It's a reversal strategy. We're going to look at what the trend was doing leading up to the London Open and then trade in the opposite direction. We're basically betting that the momentum is about to shift as all the European traders jump in. And again, no complicated indicators needed.
The rules for a long trade here are incredibly specific. At 8:15 a.m. London time, you look at the price. If it's lower than where it was 4 hours earlier, at 4:15, that's your green light to buy. You then place your buy order to execute exactly at 8:30. The exits are fixed too, a 30-pip stop loss, and you'll actually set 3 different profit targets at 30, 60, and 90 pips.
And check out this chart showing it in action. You can see the price was trending down before our entry point, which is exactly the condition we needed. The order goes in at 8:30, and just like the strategy predicts, the market turns around and heads up, hitting all 3 of our profit targets. That's an amazing 1-to-3 risk reward if it plays out fully.
And the short setup? It's a perfect mirror image. If the price at 8:15 is higher than it was at 4:15, you get ready to sell at 8:30. The rules are totally black and white, leaving zero room for you to second-guess yourself.
Okay, our third and final system is called Good Morning Asia. This one is built for the kind of person who has very little time to be staring at charts all day. The whole point is to catch the momentum from the US trading session right as the Asian market opens up for a new day.
For this strategy, we're shifting gears. We're looking at the USD/JPY pair, but on a daily chart, where each of those price bars or candles represents one full day of trading. The concept is all about momentum. We're basically betting that the direction of yesterday will continue into the start of today.
So here's how a long trade works. First, you look at yesterday's candle. Was it a bull candle, meaning the price closed higher than it opened? If yes, that shows buyers were in control. So you just enter a buy trade the moment the next day's candle opens. Your stop loss goes at the low of that previous day's candle, and your profit target is half of that distance. So here, you're risking more to win less, a 2-to-1 risk to reward. But the idea is you're catching a smaller, higher probability move.
On a chart, this is exactly what you're looking for. See this big white candle? That tells us that the previous day was super strong for buyers. It's our signal, our green light to put the Good Morning Asia strategy into play.
And here's what happens next. The trade is entered right at the open, and that bullish energy from the day before carries over just enough to hit our profit target. It's a super simple, once-a-day trade based on a signal that couldn't be clearer.
And just like our other strategies, the short trade is the exact opposite. If the last candle showed a down day, a bearish candle, then you'd enter a sell trade. The rules stay perfectly consistent.
So we've walked through 3 very different mechanical strategies. Each one has its own personality, its own rhythm. The big question now is, how do you figure out which one might be right for you? Well, let's put them side by side. The most important thing is to match the strategy to your lifestyle. The Guppy Burst is great for a day trader who can be online during that specific quiet window. English Breakfast Tea also works for a day trader, but it's even lower commitment, just one precise time to check each day. And Good Morning Asia, that's perfect for the busy person, the position trader, who just wants to check the charts once a day. And notice how the risk to reward is different for each, reflecting totally different trading philosophies.
And that brings us to a final, really interesting question to think about. We've seen how trading can be broken down into a strict set of rules, almost like a recipe in a cookbook. But if that's true, what does that make the trader? What is the role of the chef? Is your job just to follow the instructions perfectly? Or is there a deeper skill in knowing which recipe to choose, when to trust it, and how to stick with it, even when the kitchen gets a little hot? That's something every single trader has to figure out for themselves.
All right, let's get right into it. In this explainer, we're going to be looking at the powerful conclusion from Mario Singh's book on currency trading to really unlock what it takes to build a successful trading career. So, have you ever heard this phrase, that trading is simple, but not easy? It's a total paradox, right? But understanding what this really means, well, that's the key to everything. It's the central challenge that every single trader has to face. And look, this isn't just some random theory. These insights come from a guy who's trained over 20,000 people in currency trading. So you have to wonder, after all that experience, what did he figure out was the most important lesson of all?
Okay, so let's really unpack that whole simple but not easy idea. First up, let's tackle the simple part. Why on earth would anyone call trading simple? You might actually be surprised.
Well, the simple part really just boils down to 5 basic rules. First, you got to use the correct time frame for whatever strategy you're running.
Then you need the right indicators with the right settings to give you clear signals. Third, and this is a big one, you have to follow your strategy's rules every single time, no exceptions. Fourth, you got to double check everything before you hit that buy or sell button. And last, you have to keep a trading journal so you can learn from your wins and your losses. See? On paper, it's just a checklist. Pretty straightforward. That's the simple part.
So, if the rules are that simple, why isn't everyone a millionaire trader? What makes it so incredibly hard? Well, here it is. This is the hard truth. The biggest thing standing in your way isn't the market. It's the person looking back at you in the mirror. The real battle is all in your head. So, how do you actually win that fight inside your own mind? Well, the author shares this amazing lesson he learned from his mentor, and it breaks the entire path to success down into just 3 essential steps. Step 1 is, you guessed it, knowledge. This is your foundation. It's the basics, you know? Stuff like how to read a currency quote, what actually makes the markets move. You have to know this stuff cold.
But hey, just knowing stuff doesn't make you any money, right? That brings us to step number 2, action. This is where the rubber meets the road. It's taking what you know and actually applying it, watching the markets, following your plan, and pulling the trigger on treats. Okay, so we've got knowledge and action. What do you think the third ingredient is? The author says when he asks this in seminars, everyone guesses things like discipline or determination. And yeah, those are super important for sure, but they aren't the crucial third step. This final piece of the puzzle, this is the one thing that truly separates the successful traders from everyone else. It's the engine that powers everything we've just talked about. The answer is desire. And we're not talking about just kind of wanting it. No, this is a deep, burning, absolutely unshakable desire to succeed, no matter what. You know, the author's mentor had this incredible way of defining desire. He said, if I can't, then I must. If I must, then I can. Just think about that for a second. It's a mindset that turns impossibilities into necessities. And that's the one thing nobody can teach you. It has to come from deep within you. And the author himself is the perfect example of this. He's the first to admit, hey, I'm not some genius. I don't have a fancy finance degree. But what he did have was something way more powerful, that unstoppable desire to make it work. So let's say you've got that fire in your belly. You have the desire. So what now? Where do you even begin this journey? Well, it's actually way more accessible than you might think. You can just forget that whole idea that you need to quit your job and risk it all. To get started, all you really need is 1 to 2 hours a day. Seriously, the market is open 24 hours, so you can fit this into your life right now and start building that skill without turning your world upside down. And all of this leads to the final and maybe the most profound point of all. Trading isn't just about charts and profits. It's the ultimate mirror. How you deal with greed, with fear, with patience, it reveals exactly who you are deep down. So the most important question isn't about what strategy you should use or what indicator is best. It's this. When you finally step into the market and you look into that mirror, what is it going to reflect back about you? That right there is the real journey.